We'd go from 0 to 100 overnight, right? Every country would be on notice that the game is on now, and there'd be a a gold rush for owning Bitcoin. Corporations, governments, institutional investors, financial advisors, family offices, each of which moves to a slightly different cadence. And so at the same time that, let's say, retail would actually pull back and sell, you have people investing in their retirement accounts that buy each month. At the same time that maybe that's not enough to keep up, you have corporations or governments coming in and buying. It's just going to smooth things out. Now, it's not going to be up only. I'm not saying that. It's not going to be like investing in short-term treasuries. It's still going to be volatile, but it's going to be less volatile than it was in the past. And I'm not even sure we're going to see the same sort of 4-year cycle trend.
Matt Hougan opens with a striking observation. Central banks are rapidly boosting their gold holdings. This trend has been a dominant force over the past year and a key catalyst behind gold hitting all-time highs. But what's really driving this global shift toward hard assets? The answer reveals deeper concerns about monetary stability, inflation, and long-term economic resilience. And before that, be the one who says, I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
The thing you see in the world right now is central banks dramatically increasing their allocation to gold, right? That has been a major theme over the last year. That's a big reason why gold is at all-time highs. The reason they're doing that is that the U.S. has weaponized the dollar, right? We seized Russia's treasury assets, and central banks around the world realized they needed to diversify their holdings into hard assets that weren't subject for seizure. So that's a rational response. I think central banks are going to look at it and say, if you look at the hard asset currency market right now, it's 90% gold and 10% Bitcoin. That's just, again, objectively true. Gold's a $20 trillion asset. Bitcoin, say, $2 trillion. If you have 100% gold exposure, you're short Bitcoin. Like the neutral position for central banks is going to be 90% gold, 10% Bitcoin. The U.S. is moving in that direction itself with the establishment of the strategic reserve. I don't think countries around the world can run the risk of being on the wrong side of that history. It's akin, in my mind, to the early days of the internet. If you were a newspaper and you saw like 10% of your audience was reading your newspaper in a digital format, was the right response to just ignore it? Or was it to launch a web effort? It was clearly to launch a web effort. And time and again, people are skeptical of these digital versions of analog goods. And time and again, the digital version comes to parity or more. I think central banks around the world have been put on notice that they need to at least get to a parity position of 90-10. And I think you're going to see that happen very fast this year. I suspect, maybe there are 10 countries that own Bitcoin today. By the end of the year, I suspect that'll be 20 or more. We'd go from 0 to 100 overnight, right? Every country would be on notice that the game is on now, and there'd be a gold rush for owning Bitcoin. If we make the statement that you need to be balanced, and we make that statement particularly if we make the statement by selling gold to buy Bitcoin, I think you're going to see every country, not every country, but virtually every country start to want to build a position in Bitcoin. Because there is a world in the future where the world wants an apolitical currency to settle international trade. And if you don't have a staked position in that before that happens, you really, really missed out. So I think if that happens, we're off to the races. I think even if the US government uses other means to acquire Bitcoin to build that reserve, I think we're off to the races a little bit slower, but still off to the races. And I expect that one of those two versions, I think, will happen within the next 12 months. I think they're going to be less volatile than in the past. The reason is that there's just more diversity in participants. If you go back like 10 years ago, it was all crypto native cypherpunk types who were early to this space and had one worldview that was very high risk tolerance. And so you would see them do things like adding leverage as the price went up, and that created, extra volatility. And maybe they didn't invest the way most people invest in stocks, which is through their 401ks, putting 2% of their salary to work, every month or whatever. What's happened over the last few years is that we've added to that retail contingent corporations, governments, institutional investors, financial advisors, family offices, each of which moves to a slightly different cadence. And so at the same time that, let's say, retail would actually pull back and sell, you have people investing in their retirement accounts that buy each month. At the same time that maybe that's not enough to keep up, you have corporations or governments coming in and buying. It's just going to smooth things out. Now, it's not going to be up only. I'm not saying that. It's not going to be like investing in short-term treasuries. It's still going to be volatile, but it's going to be less volatile than it was in the past. And I'm not even sure we're going to see the same sort of 4-year cycle trend on an ongoing basis. I think it might look different than that, particularly for the next few years as these institutions really come into the space. They just have so much Bitcoin to buy to get to neutral that I think there may be a few very good years ahead of us for now. I know a lot of people like to look down the chain to these smaller cap assets or these different sectors, which are exciting, but you have to remember that like 2/3 of the market is Bitcoin. And many of the people, as you mentioned, that hold Bitcoin don't want to sell it, but still have to pay the rent. And so they want to generate, 2, 3, 4, 5% yields. How can you do that? You can do it through staking with Cordell or Babylon. You can do it through lending. There are lending programs that are emerging. You can do it through option overlay strategies. There are probably other ideas. But in terms of the place to build as an entrepreneur, I think it's one of the most exciting places. It has this really unique thing, which is there's a mismatch between how much time we spend talking about Bitcoin versus how big it is in the market. We talk a lot about Bitcoin, but I'm not sure we talk about it 2/3 of the time, right? We talk about ETH, we talk about Solana, we talk about DeFi, we talk about DePIN. I think we underweight the importance of Bitcoin, and very few people are talking about this income thing. I think there are going to be multiple unicorn companies built helping people generate yield on Bitcoin, particularly if you think Bitcoin is going where I think it's going, which is there are going to be a lot more people who have substantial wealth in Bitcoin. They're not going to be comfortable at 0%. They're going to want to do something with it. So I think it's going to be a huge place of innovation over the next few years.
The U.S. is grappling with a staggering $37 trillion national debt and an annual deficit exceeding $2 trillion. Making matters worse, foreign demand for U.S. Treasuries is fading. Traditional buyers like China are stepping back, driven by fears that their assets could be subject to political retaliation or seizure. This raises a critical question. What happens when the U.S. needs to roll over massive amounts of debt, but the usual foreign buyers are no longer willing to fund it? The EIO answer could reshape global markets and accelerate a shift toward alternative stores of value.
The U.S. has a lot of debt and is creating more debt all the time, right? We have $37 trillion in debt. We have a $2+ trillion annual deficit. And that means that people need to loan the US money. Historically, the people who primarily loaned the US money were foreigners, at least for the last 20 years, right? China was a massive buyer of US treasuries. Other countries were massive buyers of US treasuries. But that started to fall substantially. One catalyst was the US seizing Russia's treasury assets, which told foreign nations that aren't our explicit allies that there's risk in buying US treasuries. You don't want to buy something if the US might effectively just cancel it because of geopolitical reasons. So the US faces this challenge, which is we have $37 trillion of debt. We periodically have to refinance it because that debt comes due. I think there's like $12 trillion that needs to be refinanced in the next couple of years. And the primary buyer is disappearing. So what do? There are really only two answers. We could ask US investors to buy more debt, like me and my wife and her mom, but that's a limited market. Right. And so they wouldn't be able to buy as much debt as we need, which would mean we would have to offer higher interest rates, which would drive up the cost of borrowing. It'd be bad for the US. The other is to find a new buyer of that debt. That's where stablecoins come in. Stablecoins, as you mentioned, are digital dollars available on the blockchain. What that means is that anyone around the world can access dollars now through their cell phone. If you're in Argentina, you can create a digital wallet and buy stablecoins to get exposure to the dollar instead of the Argentinian peso. If you're in Turkey, which has faced a huge devaluation of the lira over the last 6 months, there's an enormous spike in demand for stablecoins. If you're in a region with difficult financial infrastructure, we complain about the financial infrastructure here in the US, but try to do a cross-border payment in South America, in sub-Saharan Africa, in parts of Asia. The costs are extraordinarily high. If you're in one of those countries, you can now buy a stablecoin to prevent your money being in the local currency, which might be debased, or to conduct transactions on US quality financial rails. And there are a lot of people globally, right? There's another 8 billion people. So what stablecoins do is they open up demand for those dollars from all those retail consumers and businesses everywhere outside of the US that's never been able to access our market. And you've already seen it grow. Already today, stablecoins are about the 7th or 8th largest purchaser of US Treasuries. And that's before we have good regulation around stablecoins. We're about to get US stablecoin regulation, which will provide a legal framework that convinces people that they're really sound. We're about to see big Wall Street banks move into this space. And when they do, I think stablecoins could be buying $1 trillion of US debt or more. So that is how it helps the US, because it finds a new buyer of our dollars, because they have to, they submit their dollars, we buy treasuries, a new source of our debt that keeps our interest payments down, that improves our fiscal situation. It ensures that the dollar remains the reserve currency of the world, and it helps the people in those countries as well. So I see it as a win-win-win. And I think it's going to be a major trend for the next 10, 15, 20 years. I think it's one of the most important financial innovations of my lifetime. And it's pretty exciting.
Stablecoins already rank among the top 10 buyers of U.S. Treasuries, even without full regulatory clarity. With legislation on the horizon and major Wall Street institutions preparing to enter the space, their role is poised to grow dramatically. In the near future, stablecoins could easily account for over $1 trillion in Treasury purchases. Matt Hougan concludes that stablecoins may be the most significant financial innovation of his lifetime, not just for their impact on global finance, but for their potential to help preserve U.S. monetary dominance in a shifting world order. Ready for more insight? Watch this next.